Hello, Baker Investments and portfolio students. So I hope everyone had a good week. The markets at least remained stable, and we got through the debt ceiling argument. So we will revisit that in December, and that will potentially cause some more chaos to markets. So at least for now, job numbers, a little bit of concerning about the economy, supply chain issues, but um, some of you have mentioned in your forum post you're at least able to stay steady or had some positive gains. So we'll see what happens next week. Again, this is just a very brief, short period of time. When you're investing, ideally you're looking at the long run of the prospects of these companies. So for this week, just a reminder about the things you'll need to do. We do have another quiz this week, so just make sure to give yourself time, study for that, and prepare for it. And then you'll have the homework as usually do using the templates and then the weekly portfolio discussion. So also want to go over some about the future assignments because we are approaching the end of the course, only 3 weeks left. So you have two papers coming up. One paper being, which is the common assessment that we use through Baker. You have to submit through TaskStream about the world event. So pick something that you're interested in. When I talk about APA, make sure to follow the APA. When it says 8 to 10 pages or 6 to 8 pages, that does include the cover page and the reference page. So if it was like a 6 to 8 pages, think of 6 written pages and a cover page and reference page are usually going to make up the difference on that. So do follow those guidelines and the rubrics because I do follow the APA guidelines, and that is important to me. It's important for graduate work. We want to make sure that we're adhering to the standards of not just at Baker, but this is for any university. Always follows quality APA standards. So, but if you do have questions on those, some people have sent me some questions. Also with the one about the investment portfolio manager or research, I put a video out there on Eugene Fama this week about efficient market hypothesis because that's something that we'll talk about, and I'll talk about in a little bit. But you could either go from like the Warren Buffett routes to the academia route. So I'm okay either way. If you think about Hiram Markowitz, William Sharp, Eugene Fama, the main thing for you is you want to make sure you can find enough sources for you to answer your questions and address the assignments of the papers. So I am available via Zoom or phone. If you want to talk about any of those things, just let me know ahead of time so I can set up a time to meet with you. So other than that, I just want to go over a little bit of the discussion of this week and what you'll be reading, and should be a little bit shorter on the video lecture this week. But first, with just the efficient market hypothesis. This idea was brought about by Eugene Fama out of the University of Chicago, and kind of what I've been stressing through the forum post along, that it's really hard to predict or know which stocks to buy, because if information is available everywhere, and this is like a competitive market, it's saying that those stock prices should adjust quickly and automatically to be in line with the investor's expected rate of return. And in the textbook you're going to read about, and this should be a little bit of review from the finance course, it's been a while, but about the weak form, that you just can't use past price information to look at these patterns and charts and predict that, oh, it's time to buy this stock. So most in the fundamental fields would say that's baloney. And you're going to read about something about technical analysis, and we mention it because there's enough people that still follow it and track these things, but underlying it should be based on these fundamentals of the ratios, the management of the company, not about some chart and pattern to tell you that whether it's a good buy or not. And then from the medium form, it says that almost any news that's related that's released out there. I think about some of the stocks you guys have been mentioning about, DraftKings or Netflix or Apple or Microsoft. It's saying that any positive, negative news or anything that's happening in the environment that may affect that company, any regulation, government intervention, that stock price should adjust immediately to get back in line to the risk that you're taking on with that stock. And if it isn't, something's off in the market, and then the strong form that says even those are the insiders, because they have to register the SEC when they're making large purchases. Like I say, a CEO or CFO is buying or selling stock. Although they do have knowledge about the company, there's not enough time to react to that to take advantage, gaining what we call arbitrage, to make a profit from it. So if markets are truly efficient, and I guess from the rational side, there's really no need for regulation. But what you're going to also read about is the behavioral side, the other according to the argument that says that maybe markets aren't always rational. We saw this like a lot in the subprime crisis, where people are driving up prices to irrational levels. You could ask that question now with home prices. Are these truly based on what should be about price, where it should be? Or are people buying homes, getting into these things, thinking later like, wow, I way overpaid for this home. I don't know why I overpaid for this home. At that time it seemed right. I had low interest rates. The future looked positive. And then, we probably will have a correction and home prices are going to start going down. And cities that depend on those for revenues are going to see their revenue streams decrease. So you have to be cautious, with those type of decisions, whether individual or, locally, about potential revenues. So, but I think you'll find this very interesting. The behavioral side too, a lot of that's Richard Thaler, some other economists, that look at these scenarios, and maybe markets are not always rational when it comes to investors and their decisions. So, but we stress in this course, and what you're learning is the fundamental analysis. You should be looking at the analysis, making rational decisions, and but still, that doesn't mean that the market is going to be rational at time, or investors are going to be rational about particular stocks. They may be driving up a stock price to irrational levels that doesn't make sense based on the fundamentals, and that's where you could take the opportunity to short that stock if you truly believe that. There's no guarantees on that, but based on your data, if you're making decisions on that, or analysts are making decisions, or this stock is undervalued based on their performance, the risk, and we should see the stock price rise. But a lot of that's going to depend on the economy, the industry, entrepreneurship, the ability of companies to continue to produce products that people want, services they want. So that can change very quickly. So, all right. The last part in Chapter 10, I'll just go through some of that. You're going to do, the focus is going to be on fixed income securities. Typically, we think about corporate bonds. Corporate bonds really do make up majority of the source of financing for companies. Perhaps they're just not as sexy as stocks, but even in your mutual funds, we're going to look at later, there are many mutual funds that keep bonds within their portfolio, especially if it's a mixed portfolio or a mixed mutual fund of different, combination of securities, such as stocks and bonds. So it's important. It's an investment opportunity for individuals, especially as you're probably nearing closer to retirement. To maybe you want to have some money in stocks. There's always that rule. The rule changes. About 100 minus your age, about the percentage you should have in stocks. If you were 70, you would have 30%. But people living longer, some advisors saying you would have to have a higher percentage to meet those expected future costs, especially as we're seeing like inflation right now. And oh my gosh, I went to the grocery store yesterday and just shocked at some of the food prices. And for most of us, our salaries are fixed during given years. So that is obviously a concern. So you're going to read about that. And again, you're going to look at, the concept that bonds have an inverse relationship to interest rates. So as the stock market is not doing well, people shift into bonds that can push up the price, which can be a capital gain. But there's also market factors with interest rates going into play right now. So, a lot of my bond funds that I've been watching, they've been decreasing in value at the net asset value recently. But a lot of that is about concerns about, rising interest rates and devaluing the bonds that are in the portfolio, because they're concerned about investors wanting to be compensated for those inflation rates in the future, and I'm going to have to request a higher interest rate in order to get that. So what that means with existing bonds in a portfolio, they drop in value. So, but you'll read a little bit more about some of the details of the bond market. But pretty much that's it for this week. But do reach out to me. I really do enjoy the weekly portfolio and you all analyzing the stocks and getting experience again in this very short time period. But otherwise, have a great week. Get your homework done early so you can watch the Chiefs game tonight. Hopefully they can pull another win out against the Bills. And otherwise, have a great week, and I will talk to you online. Take care.